Hi guys, welcome to the Saving Money Show with me, your host Sean. After seeing Dividend Bloodhounds video on how to become a millionaire with FAANG stocks, which is amazing by the way, you should watch it, I've decided to go through the FAANG stocks and see whether we need all of them because they're quite expensive, number one, and number two, what happens if one of the FAANG stocks actually pulls down the rest of them. Would it limit the time? So bear in mind that the fair value is just something that the system pulls out, and I don't always agree with it. It's just one data point to put into put into the proper place. Facebook spat out a fair value of $78.12, whereas its intrinsic value, depending on the method, is either somewhere between 215 and 235. So, as I said, I don't always agree with the fair value that the system spits out, but yeah, I'm giving you the figures anyway. And don't forget that if you're looking for a free trading platform, don't forget to check out the links in the description below. You get a free share worth up to £200 for signing up and depositing a small amount. Free trade only requires £2 deposit to qualify, and they're currently running a promotion on where for each person that signs up via a link will get a entry into a draw to win a free Tesla share. And so why wouldn't you go into it? The others require £100 or dollars depending on the app we go for. I'm registered on all of them. I use all of them. And if you find any of today's entertainment helpful, don't forget to smash the lovely like button. Helps with the YouTube algorithm and getting the video out there. And if you haven't subscribed yet, please hit the subscribe button and become part of the Saving Money Show family. We give each other updates and tips on stocks, and you get to ask me to look into any share you want or company you want. I don't charge a Discord or Patreon fee. I'll get on with the video now that old blarney is over with. Now, Apple. You may have wondered why these last couple of days Apple have gone up, because it started to slide, but it's had a couple of jumps. Now, basically, an EU court have ruled in favour of Apple regarding their tax bill. If you remember, the EU took Apple to court over the tax bill and evading tax, which could have cost them, the whole company, to tell the truth, an absolute fortune, and put them back down to $80 to $100 stock. Now, this is a big win for them, and puts them at a fair value. Winning this puts them at a fair value of $303, because I thought they were overvalued in the first place. Now, for them to be at 386 and for that to be fair value, they would need an expected growth of 21.05% instead of the 10% they've been having. So it's a bit overvalued for me, which I expected anyway. It's a shame. I really like it. They, as a company, they've got a great balance sheet. I just think they haven't been. They started off as a great innovative company, I think somewhere along the line they've stopped innovating, and now they're trying to innovate again, like with the telehealth thing and that. But I don't know. Maybe it's too little, too late. But Netflix, no, it's one that has a fair value of $140.63. Personally, I think it's closer to $240, because I think that they were incredibly innovative at the beginning, like Apple. They have changed throughout, still the leader in the field. However, you have so much competition, and we have we have seen how much market share Disney have taken with Disney Plus, and that is a new streaming service. You have Amazon Prime, you have HBO coming in to the market, you even have Genius Brands, as well as Apple TV. Now, not that I think Genius Brands are going to take anything away from these guys, but every day there's a new streaming service coming in, and I think these guys are going to find it tougher and tougher. Already, they are. Oh, sorry. Oh, jeez. How you guys stay awake with me, I don't know. I'm sending myself to sleep. Already, these guys are forced to reduce the price for overseas customers. Now, an American company operating in America is more expensive in America than it is overseas. I thought that only happened with the drug companies. Still, it spat out saying it needed expected growth of 40.08%. And to tell the truth, I think it's going to have negative growth over the next few years. People have found it worth going into Netflix purely because they did the family package. So, for instance, my brother would have package. He put my dad on it and my brother on it. Obviously, doesn't think much of me, does he? Just kidding. Now, the thing is, they're talking about getting rid of that package now, and each household has to pay. And once that happens, you'll see they're losing customers. Because people were working out, hold on, it is expensive. If I work out how much I'm paying per month, if I work out, also they're getting it and they're getting it, and some of them were getting the other people chipping in as well, then it didn't seem so expensive. But I think it'll be a change. Amazon. Now, this is a company you cannot say doesn't innovate. Now, this is a company I don't mind doesn't pay dividends, purely because I know they can invest my money better than I can. Now, this has a fair value of $1,090.91. Now, I think it may be a little problem with that, but it's one of those that if you don't get on the boat, you miss the ride. Purely because it's just constantly going up. You know, it had that period where it was loss making and people were saying it's just a bookstore, and then all of a sudden it started changing. I mean, how can you not? I know you may see him as the evil villain in the Elon Musk and Jeff Bezos drama, but look at that graph. I mean, it's amazing. Now, the expected growth rate is 35.48%. The return on equity has been 150%. You cannot argue with that, which means that it is at, no matter what the system spits out, it is at its fair value. It's just at fair value because of the return on equity. Because you know next year you're going to get a better return on equity. Now, personally, I would want to get it below that I would want to get a bit of a discount, and I thought we was going to get it because you see this dip there. I thought, oh, it's going to be a bit of and if it comes down a bit more, I'll pick it up. But let me tell you something about these dips. I did a video a few weeks ago saying how the pension funds, and when the pension funds have been selling off, the ETFs have been selling off because they're only meant to hold a certain percentage. And I said, you will also get people profit taking. You saw with Tesla that happened when it hit 17.8. And I did a video where I saw a trend with Facebook. It was hitting 240, it sell off, come down, and it go back up again, 240, it came back down again. The institutions are selling off. ETFs are selling off. Problem is, the retail investors are buying so much that no one has noticed. And then what's happened? All of a sudden, this has happened with Neo. You've had days with Apple, days with Facebook, you know, with Microsoft. What's happened is one day retail investors haven't gone into Apple, it's gone down, and people started getting worried. Then the next day Apple's gone up again. Same with Facebook, same with Microsoft, same with Amazon. People have stopped piling into Amazon, and the retail investors are still selling. So what happens? It goes down. It's not a crash. It's nothing other than they're selling, and because no one's buying that particular stock that day, it goes down. There's no other explanation for it. The same thing happened with Neo. People were saying, why has Neo suddenly gone from 19 to 13? Institutions were selling when it was going sideways, but so many people were buying because they didn't want to miss out on the next Tesla that it was going sideways. It wasn't going up, it wasn't going down. Then once people stopped buying, it went down. Now, thing is, I say I want to get it cheaper, but that's what I've been saying all along. When it was 500, when it was 1,000, you know, it's one of those, if you don't get on it, you don't get on it. No, Google. It's another one. Look at that trend line. Now, has a fair value of $1,125.56. Expected growth rate of 18.28%. Doesn't hit that, but it's close enough. I got into it when in March, April time, when everyone said steer clear of Google and Facebook, and I got in there. It cost me £998, which was about what was it? It was just under. It's not showing it on there. It was about $1,025, but anyway, no, it was $1,050. Sorry. Google are involved in so many things. People don't seem to say how, because an Uber executive stole secrets from Google, that Google was awarded billions of dollars worth of shares in Uber in their robo-taxi or whatever program. Any of that goes forward, Google automatically get a majority of the profits. Now, we've seen them invest in India and in Africa with their Loon project, because they see it as the untapped market, and it is. Some people in Africa don't even have 4G yet. I just think, I understand people going in at this price. It is above its fair value. It is a bit overpriced, but I understand people going in it. Same as I understand people going into Amazon. It's just one of those shares. I spoke to someone about Tesla before. They had a large amount of Tesla shares. They got in at 680, and I said, why don't you take your initial investment out, and they would be left with over 100 shares of Tesla that they haven't paid for. They use their profit from their Tesla to keep as Tesla shares. And I said, you could go and pick up Google shares with it if you want, or start a whole diverse portfolio. When Google is cheaper than Tesla, I don't know what to say. I love Tesla, I do. I'm just saying. And Facebook, as I said, fair value is 78.12, but its intrinsic value is 235. The expected growth is 32.19%, and it won't hit that. To tell the truth, none of them are going to hit the expected growth. However, Facebook has laid millions of miles of cable in Africa just so people could get online, so they could stream Facebook. Now, out of the lot of them, I would put Facebook. Look at that trend line. I mean, I can't believe people were complaining about the IPO when it first IPO'd, because it was $30. It was about $30, $36, $38, and it dropped to $20. Now, with Facebook, I think they're the best value out of all of them. And then you've got Alphabet, and after that you have to go with Amazon, and then Apple, and then Netflix. However, my money I would put into Facebook and possibly Google, and the others I would think I've missed the boat on. I just think they're too overvalued. Facebook is the best valued out of a lot of them. Please leave a comment if you agree with me, or if you disagree with me even as well. But that's my opinion. And I do have a small position in Facebook. I have a small position in Google. By a small position I mean 1 share. I had more, but when it went up I sold some, and I'm thinking of adding more Facebook to my portfolio. At the moment mine is tied up in a few other stocks. I'm trying to do something which I'll show you when I'm release my portfolio again, and I'll show you what I'm trying to do. It's a bit risky, a bit funny, but if it comes off it'll be good. And I'll see you in the next video. Goodbye.